Welcome to the Opening Bell Report.
Today, we're dissecting an analysis report on SOFI, which argues it's the most misunderstood stock out there. It focuses on this real head-scratcher from Q4 2025, a triple beat on earnings, but then the stock immediately drops over 6%. The core idea is that SOFI is facing a valuation identity crisis, with the market treating it like a bank, not the tech hybrid it claims to be. Let's jump right into the argument.
Let's do it. This piece is very timely, but I want to start with how it tackles the market psychology here.
Right, the whole sell the news idea. The report makes a really strong point that the numbers, over $1 billion in revenue, $174 million in net income, are totally disconnected from the price action.
Totally.
The author even calls it a textbook gap in crap. And you can see why they're frustrated. Company hits a home run, stock gets punished.
It does feel wrong. And I'll say this. The analysis absolutely nails the disconnect between those triple beat fundamentals and the price action. But the framing of the market's reaction feels, a little dismissive. It's not as analytical as it could be.
Dismissive? How so? It seems like they're just pointing out the facts.
Well, it reads a bit like the author is just sulking. When you use terms like gap and crap, or say expectations got too overheated, you're basically just calling the market irrational.
Which, maybe it was.
Maybe, but you're not exploring the mechanics of why it acted that way. It comes off as defensive, like a fan defending their team rather than an analyst dissecting the game. You're just telling the reader the market is wrong.
I see your point. It's shifting from the market is dumb to the market is a machine that did this for a reason. So how do you actually write that? How do you explain the drop without making excuses for the bears?
That's the key, and my suggestion is to move away from calling it a misunderstanding. Instead, analyze the pre-earnings positioning that made some kind of pullback almost mathematically probable no matter how good the results were.
Okay, so practically, what do they need to add to make that argument land?
Context. It's all about context. Instead of just saying the stock ran up significantly, quantify it. What was the rally into January 30th? Was it 20% in 3 weeks?
Right, if it was, then a 6% drop is just noise.
Exactly. It's just mean reversion. And then you have to acknowledge that perfection was already priced in. The report could be so much stronger if it explained which metrics were signaling a sell the news event was coming.
You mean like looking at the options market?
Precisely. Was implied volatility through the roof? Was open interest massively skewed bullish? Citing that data changes the tone from this isn't fair to here are the mechanics at play. It turns a complaint into a valuable lesson for the reader.
That definitely adds a layer of sophistication. And it leads right into the biggest piece of this puzzle, the valuation itself. The report's central argument is this comparison between SOFI and traditional banks.
The Ally Financial comparison.
Exactly, pitting SOFI's 41x PE against Ally's 9.5x to frame this identity crisis.
And this is the absolute crux of the thesis. The report's core argument relies on contrasting SOFI directly with a bank like Ally, but this binary comparison, it really might oversimplify the landscape.
But hold on, isn't that a fair comparison? SOFI is a bank. They've got the charter, they take deposits. Why shouldn't they be compared to Ally? Seems like the most logical starting point.
It's a logical yardstick, but it's the easiest yardstick to beat. That's the weakness. Of course, SOFI looks amazing next to Ally, but it's a straw man argument.
A straw man how?
By only comparing a hyper-growth fintech to a low-growth incumbent, the report just ignores the huge middle ground. What about other fintechs, neobanks, payment processors? It's easy to say SOFI deserves a premium over Ally. It's a lot harder to argue why it deserves a premium over, say, Block or Adyen. They pick the slowest runner in the race to compare their sprinter against.
That makes sense. You can't just pick your battles. But the whole point of the report is that SOFI is a hybrid. So if you compare it to PayPal, you lose the bank part. If you compare it to Ally, you lose the tech part. How do you fix that?
I think you have to introduce a sum of the parts framework, an SOTP model. You have to validate the hybrid idea with math, not just with words.
Okay, walk me through that. Because some of the parts gets thrown around a lot, sometimes just to pump up a price target. How do you do it rigorously here?
You break the business down. Simple as that. Apply a bank multiple, say 10x, maybe 12x, something in line with Ally, to the lending segment's earnings. That's your floor. That's the bank value.
Okay.
But then you take the tech platform, Galileo, Technisys. Those are SaaS businesses. So you have to apply a SaaS multiple to that revenue stream. Maybe it's 30x, maybe it's 50x.
But the reporting is all consolidated. That's tricky.
It is, and that's where the analyst provides the real value by doing that hard work. You estimate the tech's contribution, apply the higher multiple, add the two values together, and get an implied share price. If you claim it deserves a premium for its tech DNA, you have to actually value the tech DNA.
So you're basically saying, here's what the bank is worth, here's what the tech is worth, add them up.
Precisely. It builds a valuation floor based on arithmetic, not just sentiment. It shows why a 41x multiple might actually make sense. Maybe the bank part is worth $10 a share, and the tech part is worth $15. Suddenly, $25 a share doesn't look so crazy. Without that math, 41x just looks like a bubble.
That really changes the argument from something qualitative to something quantitative. Huge improvement. Okay, let's shift to the financials, specifically cash flow. The report has a section on the cash burn illusion.
A very important section.
It argues that the negative operating cash flow isn't burn in the typical startup sense. It's just the business of lending money out the door.
Yes, and while this section is a critical educational point, it sort of assumes the reader will just accept the distinction between spending and lending without really scrutinizing the risk involved.
I'm not sure I see the problem. The accounting seems right. If I lend you $100, cash goes out, but I get a loan asset worth $100 back. I haven't burned it. The report even points to tangible book value growing to over $4 a share. Isn't that enough proof?
It proves they aren't lighting money on fire for marketing, sure, but the weakness is that it dismisses the risk too easily. Growing a loan book is capital intensive. You're trading liquid cash for an illiquid asset, and that asset has risk, credit risk, duration risk.
Right. You can't make payroll with a 5-year personal loan you own. You need cash.
Exactly. And the report treats that loan as if it's just as good as cash. That's a very sunny day assumption. If the macro environment gets choppy, that liquidity is everything.
So how do you add that nuance without killing the whole bullish thesis? The point is still that the negative cash flow is okay.
You strengthen the argument by bridging the gap between the accounting and actual risk management. Don't just explain why it looks negative, explain the quality of the asset that's replacing the cash.
Give me a concrete example. How would you phrase that?
Okay, so the report cites tangible book value growth. Great. Go one step further. Talk about the return on equity, the ROE, being generated by that deployed capital. If you're turning cash into loans, what's the yield? If the ROE is, say, 15%, then that burn is actually incredibly productive.
And the liquidity risk you mentioned?
You have to address it head on. Don't just say cash leaves to become an asset. Discuss the liquidity profile of those assets. Acknowledge the counterargument. What happens if credit markets freeze? You can't sell those loans. So you mention their warehouse capacity, their capital ratios. That shows the reader you understand the risk and you're explaining why SOFI is prepared for it.
That's a crucial difference. It turns a defensive explanation into a confident demonstration of capital efficiency. Okay, let's look at operations. The one-trick pony myth.
The student loan narrative, right.
And the report does a good job showing the shift. They highlight adding 1 million new members in Q4, hitting 13.7 million total in this financial productivity loop. I mean, that's a massive user base.
It is massive. But this is where I get a little skeptical. The analysis here is really strong on volume, but it's pretty light on the unit economics. The stickiness, as you said.
Stickiness is everything, but surely with almost 14 million people, they're making money somewhere.
Not necessarily. And that's the weakness. Citing 13.7 million members proves scale. It doesn't prove profitability per user. The report just assumes all these new members are valuable. Are they? Or are they just opening a free checking account for the sign-up bonus and then going dormant? The report equates volume with value, and in fintech, that is a very dangerous assumption.
I see. We need to prove these aren't just vanity metrics.
Exactly. The suggestion is to pivot the focus from member growth to member monetization. You have to prove that financial productivity loop is actually closing. Show me the money.
So how do you illustrate that? What specific metrics should they be looking for?
Get granular. The report says direct deposits provide low-cost capital. My question is, how much lower? Show me the spread. If deposits cost SOFI 4% and their warehouse lines cost 6%, that 2-point spread on billions of dollars is the whole story. Put that number in the report.
That's the bank charter advantage in action.
Right. And then analyze the cross-sell ratio. If 1 million members joined, how many products did they take? Is the average products per member going up? If it is, that is the productivity loop working. If it's flat or falling, you've got a leaky bucket.
That's a fantastic distinction. Okay, finally, let's talk about the forecast. The report has 3 scenarios for 2026: bear, base, and bull.
And I always go straight to the bear case. It tells you that the analyst is being honest with themselves.
Well, the bear case is $18.
And it assumes a multiple compression to 30x. But it also assumes the company still hits its 60-cent EPS target.
And there's the problem. The forward-looking price targets are fine, but the bear case feels, well, it feels artificially padded.
Padded? It's still a downside target from where the stock was trading.
It's a downside target based on sentiment, not on performance. The bear case here assumes the company executes perfectly on its earnings guidance. That's not a real bear case. That's a successful execution with a grumpy market case. It completely ignores the risk of operational failure.
That's a really sharp insight. If you're only modeling success, you're not managing risk. You're just modeling different flavors of winning.
Precisely. The suggestion is to introduce a real failure mode scenario. What happens if the fundamentals actually break?
Give us an example of a failure mode for SOFI. What would that look like in the numbers?
You have to construct a scenario where EPS misses that 60-cent guidance. What if tech platform growth slows from 38% down to, say, 20%? What if regulation hits their interchange fees? What if EPS comes in flat at 40 cents instead of 60? A true risk assessment would model that out.
So if EPS is 40 cents and the multiple compresses to 20x.
Now you're looking at an $8 or $10 stock. And by including a genuine downside scenario like that, a sub-$15 target based on actual execution failure, your base and bull cases of $24 and $30 becomes so much more credible. It shows you've stared into the abyss, you know the floor could be $10, and you still believe in the upside.
It's about earning the right to be bullish by acknowledging the bearish reality.
That's it.
So, stepping back, this report is rich with facts. It gets the narrative right, but it needs to graduate from being a defense of the stock to a dissection of the value.
Don't forget to like, share, and subscribe for more.